Don't forget, you can reach the latest episode of Potomac Watch anytime. Just ask your smart speaker, play the Opinion Potomac Watch podcast.
From the opinion pages of the Wall Street Journal, this is Potomac Watch.
Welcome back. Alicia, is there anything else that you would pull out of this Labor Department CPI report as potential indicators of where the economy might be going?
Well, there's been a lot of attention has been on the shelter index, and people were expecting that to go down, and that has remained, as Monet said, sticky. It's around 0.4%. But the inflation across the board, or CPI across the board, especially in the services, it was quite elevated. If you look at it, whether it be for medical services, auto insurance, airfares, hotels, everything was elevated. It was far above 2 or even 3% year over increase. And some of this actually may be a lag effect. One other thing I would note is that retail spending was actually quite elevated also in January and higher than many expected. And that may have actually been a result of people trying to buy things before the tariffs hit. And so the extent that that temporarily boosted demand on a 1 month basis, that may have actually increased prices or given companies a little more leverage to increase prices. One other thing that I would maybe note is that the real average earnings, which is after inflation, were flat for this last month, because any wage increase was basically offset by the inflation. And actually, the real average weekly earnings did decrease by 0.3% as a result of the decline in the average work week. If you recall, under President Biden, you actually saw for most of his term a decline in real earnings after inflation. In the last year and a half or so, you started to see real wages actually increase after inflation. So people started to actually make up for the ground that they lost. But it's concerning if all of a sudden now you have earnings, or at least on an average hourly basis, now falling behind again inflation. And that will not make Americans feel better about the economy. You're starting to see that in some of the consumer confidence reports, too, that people are becoming more pessimistic again about inflation and the American economic prospects.
Meantime, Federal Reserve Chair Jerome Powell was up testifying on Capitol Hill today. Here he is explaining his view of where interest rates should go.
We'll make our decisions as we go about what to do with interest rates based on, the data that we see, the outlook, the evolving outlook, and the balance of risks. And, we'll be considering all of those things. We won't be focusing on any particular policy, and I can't tell you, what we'll be doing, because it will really depend. It's a fairly uncertain environment right now. Yeah. The underlying economy is very strong, but there's some uncertainty out there about new policies. We're just going to have to wait and see what the effects of those policies are before we think about what we can do.
And here he is speaking a little bit more broadly about that uncertainty.
It's possible that the economy would evolve in ways that, because of tariffs, or partly because of tariffs, that we would need to do something with our policy rate. But we can't know what that is until we actually know what policies are enacted. And remember, it's not just tariffs. There are significant changes to immigration policy, fiscal policy, and also regulatory policy. You put all four of those, and all four of those were things that the president was elected to do. We will then try to make an intelligent judgment about the overall effect on the economy of those, and conduct our policy accordingly.
Monet, what's your read of that? Cautious, inscrutable, as Fed chairmen often are, or on the other hand, I grant that there is some real uncertainty here. The world doesn't know if President Trump in 2 or 3 weeks is going to wake up and put broad tariffs on America's largest trading partners. And, who else doesn't know that is Jerome Powell.
Yeah, I think that if you were to take that first clip on its own, where he describes looking at the data carefully as it unfolds and making decisions week by week, it would be basically inscrutable. It could mean anything. It basically would suggest that they aren't articulating where it might go because they're uncertain. But I think the best way to get some clarity out of it is to put it in historical context and compare it to how Jerome Powell was speaking just a few months ago, that I think was clearly cautiously optimistic. The idea was that inflation was declining with a few bumps on the way down. It wasn't necessarily consistent, but you could say at that point, say in the summer and fall of 2024, that inflation was generally on its way down. And the question was, are we going to cut rates too fast and potentially overshoot and heat it up again? Or should we moderate the pace of the cuts to make sure that we achieve a soft landing, quote unquote? Jerome Powell isn't sounding like that today. You couldn't even call him cautiously optimistic. I think it's really a wait and see approach. And the possibility that inflation might heat up further is real at this point. And so nobody really knows exactly how many more cuts to anticipate. And then you have the additional complications of the Trump policies. So I think that they're trying to figure out what impact the tariffs might have, how serious the president is about those, and creating a model for how they're going to affect the macroeconomy. But it does seem as if the Fed's attitude has really substantially changed, and businesses and consumers aren't going to bank on consistent interest rate cuts this year the way that they would have before the past few months.
Alicia, we'll give you the last word, but what's your read of this? And as a reminder, the Fed's target for inflation is 2%. And its favored measure is not the consumer price index. On the other hand, a consumer price index of 3% year over year, 3.3% core, that makes it pretty hard for me to see an argument that the Fed ought to be running to cut rates right now.
Right. I think it was probably a mistake to cut rates last fall in September when they did by 50 basis points. I think that set up market expectations. I think that also could have contributed to obviously less restrictive policy and potentially a wealth effect. And by wealth effect, I mean people were feeling the stock markets increase and the other asset prices did as well. Some of the people who owned assets and stocks felt a little wealthier, may have gone out and bought more things. And this could have contributed at the margin to higher inflation. There haven't been many studies on this. I know the Fed board members are looking at this and to see whether, maybe the wealth effect, which was, by the way, the point of the quantitative easing during the Obama administration, whether that is contributing to higher prices. But I think the overall take is that, they need to be cautious. This was never going to be an easy, soft landing. I think, in my view, that's always the last mile. That's the hardest to hit or land, and we're seeing that.
Thank you, Alicia and Monet. Thank you all for listening. You can email us at pwpodcast@wsj.com. If you like the show, please hit that subscribe button, and we'll be back tomorrow with another edition of Potomac Watch.